Hello and welcome to the special webinar from Fat Profits. My name is Roger Malik, the Head of Client Services and your host for today's webinar. Thanks for your company. And joining me today, I'll introduce our panel first. We've got our Senior Account Manager, Edward Allen. Edward, welcome to this webinar. How are you today?
Hello, Roger. We're almost there at the end of the year. So looking forward to updating investors today.
Absolutely. Look, we're nearly the end of the year. Christmas bells are about to ring, but we've got a lot to talk about in this webinar. And joining us also is our Senior Account Manager, Colin Dransfield. Colin, welcome to this last webinar of the year. How are you?
I'm very well, Roger. Hello to you and Edward and all the viewers, and Merry Christmas to everyone that's tuning in. What a tremendous opportunity to review 2022. Really looking forward to today, Roger.
Absolutely. Look, there is a lot to talk about. We are going to have a discussion on about 20 stocks today. So we're going to review all our, well, not all, but quite a lot of our stocks from this year, the winners and losers. You're probably going to add some notes if you've got a pen and paper handy. There's going to be good discussion on 7 sectors. So we're going to break that down in the ASX. We're also going to look at some key data on and some indicators pointing to 2023, whether we are going to see a continuation of this bear market or we're going to see a market bottom. So we're going to highlight some indicators for you, which you may not have seen yet. So stay tuned. Let's get started. First thing first, a quick bit of housekeeping. All our presentations from Fat Profits are general in nature. We don't provide personal advice during these webinars. If you're looking for that, please see your financial planner. Also, past performance is not an indicator of future performance. Now, during this webinar, we will encourage you, if you have questions, please type them where you see the orange arrow on your chat box, and you can type in a question. It comes on our screens, and we'll do our best we can to answer those questions live. So feel free to do so. Let's get started now. So first thing first, we are going to look at maybe the first 5 minutes of this webinar. Well, let's look at the big picture, what's happening in the markets, the economy, what's shaping our world today as an investor. So first thing first, have a quick look at the S&P 500, the 500 biggest companies in the US market. Now, this chart clearly shows what's happened since COVID, since we saw the drop. The markets have gone absolutely crazy from 2,200 points up to 4,800 points, all-time highs. And since then, we've seen this year, 2022, a continuation of lower lows and lower highs. And we've seen a lot of resistance at this, where you see this blue line. It has been tested 4 times and has failed, and now recently got tested, and now we're back down again. And you can also see some indicators down below. We see the PPO MACD, again, pointing to another drop coming up, which has happened 3 or 4 times this year. Now, ASX 200, on the other hand, has been a lot more stronger, mainly thanks to our financials and commodities, with more than 50% of our index has held well above the support line of 6,400 points. However, it is also looking like it is topping out in the short term, and the indicators now starting to point, as you can see at the bottom, a reversal of this momentum at this point in time. Let's have a look at what has shaped 2022. Well, history will remember 2022 as the year of the Fed, the central banks around the world. And, you know, a bit of a joke, but don't fight the Fed, or don't fight the boxer in your picture, because they will crush you. And look, the Fed has crushed the market this year. However, this screen, and we do a lot of research here at Fat Profits, we look at a lot of history and the data which points us in the right direction. And this particular stat here will show you that 6 times when we've seen bear markets happen and we see the market bottom, it actually does not arrive until the Fed actually starts cutting rates. So let's have a look at a few examples. If you look at 2007 to 2009, where you see the orange lines, that's when the Fed actually started, that's when the market bottom happened. So all the orange lines, you were seeing 6 of them, that's when the market bottom took place. Now, the red line that you're seeing there is the Federal Reserve cutting or increasing rates. Now, if you look at, say, 2008, prior to that, the rates were rising. Then they started flattening. The market started dropping. And as the Fed started cutting rates, markets kept dropping further until March 2009, when finally we saw the market bottom. Now, Fed had already cut rates down to zero by then, but the markets continued their downtrend. Another example, 2000 and 2002 bear market, the market started dropping in 2000, kept dropping till 2002, and the Fed started cutting rates already, and they kept cutting it, cutting. The markets did not bottom until 2003. And the history, and this goes on into previous bear markets as well. Now let's fast forward to today, 2022, rates are rising at a rapid pace. They have not finished yet. We still see another 2 rate rises in December and January in the US. So that means we're not even close to pausing, let alone cutting. The markets have dropped this year so far. We don't think we are remotely close to a market bottom just yet, because that typically, again, indicators will show you that typically a market bottom happens when Fed actually starts cutting rates. In our view, that's a story for the second half of 2023. So what does that mean? We expect this bear market to continue to have higher lows lower lows and lower highs, and that's an important stat. What's the other thing happening with cash? And this is another indicator. We look at fat profits, cash allocation. At the top, you can see the S&P 500. At the bottom, you see the cash allocation. Cash allocation is rising because more and more investors are getting out of the markets and sitting on cash, and that's a sign of volatility, sign of fear in the market, and that is most likely going to continue to rise. And you can see this stat only goes back to 2009, when the cash levels were absolutely at peak, around 45, and then they started dropping as we started seeing markets rising. At the moment, the cash is still rising, markets are dropping. We expect this to continue into well and truly into second half of next year, and this cash level could, and it's an important one to keep an eye on. We expect this to at least go to 30, if not higher. So that's an indicator of what's going on. The other thing is asset allocation. And this is another stat we look at, is what is happening to asset allocation. Is it rising? Is it dropping? Now you can clearly see as the markets are dropping, the asset allocation is dropping. People are getting out of the market. And if you look at the previous history of 2000, 2002, the asset allocation really started dropping as the markets continued to come down. 2007, 2008, GFC, they really came down to historical low levels before we started the allocation coming back in the markets. Now, here's another thing you might find very interesting. Let's have a look at this 2002. So keep this stat in mind before I show you the next chart. 2002, the markets dropped, a little bit of revival, further drop, revival, and then something happened. There was a big capitulation and the markets dropped, and that capitulation is right here. You can look at this is the S&P 500. You can clearly see the first year or year and a half, the markets dropped, but the biggest capitulation happened in the final leg of this market. 37% drop in a matter of a few months, and that's when people throw in the towel. You look at, fast forward that to 2008. Let's look at that again. 2008, you're seeing markets again continue to drop, but the big capitulation really took place in the last leg. And you see that here, 54% drop in the final leg in the 2008 crash. That is, of course, very scary. Post that, of course, we've seen a huge rally. So just something to keep an eye on. And since then, we've seen the markets recover from March 2009 onwards, and we've made high highs and all-time records. Another last key indicator is something we also look at fat profits, is volatility index, which is called the VIX. This is a gauge of fear in the market. Now, what you're seeing here in the yellow is the S&P 500, and what you're seeing here, the other lines, is the VIX. And you notice again, VIX really goes through the roof. In other words, volatility picks up when markets drop. So 2008 crash is a good indicator. The VIX index really went up to as high as 90, almost nearly touching 100. That is absolute peak. Before that, in 2002, when the markets dropped, it reached about 50. And every time we've seen a bear market, VIX really shoots up. And you can see in 2012, 2015, it went up to 50. 2018, markets dropped 20%. It went up to 50 again. Of course, in 2020, COVID, the VIX again went back up to 80, 90. There was a lot of fear. Markets dropped 40% in a month. So yes, we've seen that. Now, compare that to today, the VIX is actually right now, it's 20. That is very, very low. That means investors are not too fearful just yet. You know, there's a bit of complacency come back in the market. And if you look at a shorter term picture here, you can also see while the markets have come off this year, this is also an indicator for swing traders, is every time the VIX, the markets come down, VIX actually does go up. And when the VIX comes down, the markets really start to come off. And this has happened many times in this year alone. And you can see again, the VIX coming down, markets topping out, and that's when people start selling off. So right now, VIX is now starting to shoot up. Is that a sign that the markets again going to come off? So we're going to talk about that. So that's a bit of macro for you. Hopefully you found that useful. Let's now talk about stocks. We are going to review the 2022 year. We're going to cover at least 20 to 25 stocks now, and we're going to go into 7 sectors on the ASX. So plenty of hot sectors here. So first, Ed, over to you. Which sector you want to cover? Maybe agriculture, so the soft commodities. Let's start with that.
Yes, soft commodities, Roger, which has been one of the better performers this year in the markets. So this is over the last 12 months from January. We only in 2021 we initiated coverage on Treasury wine estates, and you know, the more the market gets volatile, I guess the more people want to drink. But some of this stuff's going overseas as well, so there's been some currency fluctuations as well. So yeah, Elders was having a great year until recently, and they've dropped. But that is a stock that can clearly turn around. So it was on track to have a positive year, but we're very confident that that stock will turn around. New Farms had a pretty good year, traditionally a volatile stock, but their products, especially in technology sector, are very well in demand, especially as regional areas recover from floods and the bushfires in the summer season. So this stock is well on track there. Their financial numbers are fantastic. Australian agriculture, I don't know if anyone's checked the price of beef or meat in the butchers, but the price of cattle is going up because of floods and so forth, and a lot of this stock does go overseas as well. So there's been some currency fluctuations as well. So you can clearly see our members have really been benefiting. And the last one is Intertech Pivot, which just went ex-dividend, paid a fantastic dividend recently, up around 32% for the year. Again, some currency fluctuations there, but a very valuable product. In particular to the agri sector and also the mining sector as well, with their explosives business. But there you go. There's 4 stocks that members have made money from this year if they followed our recommendations to buy.
Even though the market's been down this year, Ed, but look, we're in a lucky country where we've got a lot of good resources here. So look, if you missed out on any of them, look, you can check out. But let's talk about the agri index and some of the big companies here.
Yeah, sure. So obviously we can't cover every company in the market, but you can clearly see there that you've got the likes of Grain Corp and Costa Group, A2 Milk, which has not performed. Bega as well has had their struggles. United Malt has actually been okay. People drinking more again, beer. Rural funds have come out pretty good. Ingham's not so great. But you can clearly see there is a sector there that is on the cusp, and it just comes down to performance and balance sheets at the end of the day. The companies that do it well are going to be profitable, and they're the ones that we're covering, and the others will be left behind. But the food inflation is definitely here. So you can see those numbers there, the green chart in particular. Those numbers are only going to go up. So the demand is clearly there. We're well positioned. We're also trusted as an exporter as well. There's another little micro stock that we cover as well, which is well positioned that new members can have access to. Just completed a capital raising. That's another one that we cover, but you can clearly see there that the demand is there. So it all comes down to balance sheets at the end of the day. So Intertek Pivot, as you can see on the screens there, 1 billion in earnings, operating cash flow is strong. The capital management is fantastic. Done some on-market buybacks there as well, and you can clearly see their net debt has gone down, and that's a key metric in balance sheets going forward for every company on the ASX. It's all about earnings going forward. Roger?
Absolutely, you're right. So it's all about earnings, and looking at the chart as well over the last 12 months. Look, even the market's been choppy, but stock has actually done well. So it's made money even in a bear market. So that's a good sign of things to come. So IPL remains in our portfolio. So if you've had that, you would have made some money. Treasury wines, on the other hand, Ed, like you said, you probably like a good drop of Shiraz or something.
Yeah, it's a good staple stock. I mean, it's managed well. During these volatile times, people tend to drink more, and people with the top 1%, which is what they target really, have got the money and they're willing to spend. And the export market is fantastic here. There's a currency tailwind as well. So this stock will continue to grow. Australia is probably one of the biggest drinkers globally, but also we're well trusted as well. So our export market is very strong, and this is one company that's benefiting from that.
Absolutely.
So that's a good stock in the portfolio. And also Nufarm, Roger, we spoke about earlier. Well positioned. This is a stock that hasn't broken out. It broke out previously. It dropped, and now it's breaking out again. So it is a volatile stock, but if you get it right and you get the timing right, we have had some pretty good buys on this stock, well under $5, well into the $4 range, and now it's well projected. So this is a stock that we expect to grow from here. The balance sheet is strong, and we do have a buy recommendation for members with no exposure on this stock.
Absolutely. Thanks, Ed. So look, there's a lot of sectors that we're going to talk about, but look, agriculture, sometimes investors overlook this space. So it's important. We've highlighted a few stocks for you. We've even highlighted top 10 stocks on the market. No, we don't cover all of them. We cover the first, third, and the fifth best stock in terms of market cap. So hopefully you've taken some ideas from that, because you can make money even in a down market if you get it right. Well, talking about making money, well, energy has been phenomenal this year. Colin, it's a huge part of fund managers' portfolios, institutional investors, and of course, mums and dads. So what's been the key takeaway in the energy space this year?
Yeah, absolutely spot on, Roger. So the energy sector has been a real standout performer in 2022 off the back of surging gas prices. Now, there's geopolitical overtones of that in Europe, which I won't get into, but suffice to say, Woodside and Whitehaven Coal have really benefited from surging energy prices. Firstly, Woodside. A little bit of trivia for you, Roger. Woodside, founded in 1954. It's actually named after a small town in rural Victoria, in Gippsland, Victoria. And so the company's 68 years old. I'd say it's had probably one of the best years since inception. In 2022, Woodside and BH Petroleum merged to create a new chapter as a global energy company. So it's up 69%, Woodside. Whitehaven Coal, a similar situation. Whitehaven Coal is actually the best performing stock on the ASX 100. You can see some full year 22 financial highlights there, Roger. It's a record year on the back of $4.9 billion worth of revenue, $3.1 billion worth of earnings. But the big takeout from this slide, Roger, is down in the right-hand bottom corner. total shareholder returns 154%. That's
Wow.
number one in the ASX 100. So this has really been a fabulous year for Whitehaven. You can see that we originally got into the stock at $2.46. About 18 months ago. We did sell half on it at $4.83. We've been encouraging members to take profits off the table, to cash up, to then prepare to buy undervalued stocks on the dip when the market bottoms out. Whitehaven Coal is one of these stocks. We've currently got a hold on it, but really, Roger, this has been a dream stock, Whitehaven Coal, for Fat Profits members and investors in 2022.
Oh, yes. Look, well said, Colin. Look, this has made a lot of money for investors and still is. Look, still holding up pretty well. So it remains in our portfolio. The question is, did you get into any of these energy stocks? If you did, congratulations. You're probably smiling at the moment looking at these charts. Another stock, as you said earlier, Woodside has been you're probably right, Colin. This has been one of their best years, finally. It's been frustrating for members or investors for some time, but this was the year, 2022, for them.
Absolutely. So once again, Woodside has had surging production and firmer energy prices, particularly with surging gas prices. So that, as we saw in the previous slide, Roger, the stock is up 69%. It's even for the full 1 year, it's up 11% in the last 6 months. And so that's really one for investors and members to keep an eye on going forward. We can see some results there. Net profit after tax, 1.6 billion. Well, that's up 417%. But also very strong operating cash flow. And we know that cash flow is the lifeblood of any business. And as far as Woodside is concerned, 89% increased cash flow has really provided a tremendous operating platform. Once again, operating revenue at 5.8 billion, up 132%. There's that cash flow again, 2.5 billion of free cash flow. It's up 700%, and unit production costs are also up a little bit, but overall a very strong result. You see the chart there. We've currently got a hold on Woodside. Woodside is a stock that really should be in every astute investor's portfolio. We expect big things from this stock in 2023, and so certainly one to keep an eye on.
Thank you, Colin. Look, it has almost doubled from lows of $20 to, it did reach a high of 40. So anytime a top 100 company doubles, well, you would have done well. However, our view for the timing is currently a hold. So we just want to make sure we're not buying it just yet. So we might look at buying on the dips in the future if there is a bit of pullback in oil price, but for the timing remains firmly held in our portfolio. Next sector I'm going to cover is lithium, nickel, and copper. Has been absolutely hot for the last 2 years in the market, not just in Australia, but all around the world. This is where the feature is: electric cars, electric batteries, and it's all made out of lithium, nickel, copper, the key essential ingredients for that. Here's the 5 stocks that we cover in our portfolio amongst a few others. But look, the probably out of the big ones, Allkem, AKE, IDO, Independence Group, they're the big producers. Sandfire Copper, that's been a bit down because copper's had a tough year, but then you've got 2 others in lithium and nickel. Let's talk about the first one here, Allkem, AKE. They have huge operations both in Australia, where you can see Mount Cattlin, that's the Western Australian project. They also have this Olaroz, which is in Argentina, where the headquarters is also based. Currently, it's a whole recommendation. Keeping in mind, this is the 5th largest lithium producer in the world. So this is quite a big company now. They have merged with, formerly known as Orocobre, and they also merged with Galaxy Resources about a year ago. Now, have a look at this if you haven't seen this before. The forecasted demand for lithium over the coming 10, 15, and 20 years. This is where we are heading. And before you know it, we'll all be driving an electric car. Probably Edward is already driving a Tesla, I'm pretty sure. But we all will be very
not
soon.
Yet.
Not yet. You placed an order, Ed?
We're just not there yet. We're at the halfway mark, Roger.
All right, okay. But look, we are heading in that direction. So look, if you look at AKE as an example, look, the last 1 year, they've return for shareholders 68%. Last 3 years, absolutely phenomenal, over 500%. And numbers really do all the talking for you. You know, the net profits after tax have gone up 4 times. And this is all based on the demand for lithium, which just cannot have enough supply. You look at the charts, well, absolutely phenomenal. Over the last 2 years, we bought it at $1.71, as you can see at the bottom left, and we've rode it all the way. We bought it multiple times, as we do, dollar cost averaging, and you know, it's currently around $14 a share. If you put in $10,000 there, you'd be sitting on over $80,000, nothing to sneeze at in 2 years. So look, currently remains a hold. We'll probably look for a better entry in the future. The next one to talk about also is IGO, Independence Group, and they took over Western Areas last year. Also similar size to AKE, about $8 billion worth. Good portfolio of lithium and nickel projects. You can see some of them in Australia, around WA, even Northern Territory, South Australia. So they've got a pretty diversified portfolio, and they're producing plenty of materials for clean energy. Financially, if you look at the health and fundamentals, you know, you can really see, you don't need to be an expert to look at the earnings rising. Yes. Is the cash flow rising? Yes. Revenue is pretty strong. Management is strong. So you really can't argue. What's been the results like? Well, share price always follows earnings. And this is another great example. $3.44 was our entry. We haven't sold it yet. We have bought it a few times. And there was a reasonable pullback, actually, gave members an opportunity from $15 down to $9, $10. And we got in again. Now it remains a hold. So that's another one which has had a good success. The last one is, look, essential metals. If you're looking for sort of a junior explorer, probably more of an advanced explorer, is up 150% in the last 12 months alone, from 10 cents to 40. It is a bit more volatile than a producer, but it remains in our portfolio for the next few years. So that's another one to check out. Now, let's have a look at, take a break from stocks. Let's look at market direction. Now, Angus, this is a picture of our CEO, Angus Geddes. He writes every morning to our member base, and he explains where the markets are at and where he sees them in the short term, because he's a fund manager. So he trades the market in different models that he manages, about a couple of $100 million of real money. So let's have a look at, and he's been right pretty much bang on all year in his market direction. And here's a couple of examples to show you. And if you really want to benefit from some indicators, some commentary on where the markets are going, we are forward thinkers and we're market predictors. We're not commentators. We don't just comment on what's taking place. We predict where things are going. So here's a couple of snapshots to prove to you what he has been saying all year. So look at July 28th. He talks about inflation and the reporting season about what's going on. But here's the key takeaway for you. It says the rebound on Wall Street could extend for a few more weeks. However, I remain skeptical that the S&P 500 can advance beyond 4,100 to 4,150 level, where overhead resistance is significant. A retest of the May and June lows is probable as we head into September and October, with the bear market in the S&P 500 likely to have one more leg lower, in my view. What do you know? That is exactly what happened. 4,100 was resistance. The markets dropped, and we retested the May and June lows as we headed into September and October. So this was absolutely bang on. Colin, maybe I might get you help on the October 15th one. That was another prediction that Angus made. Do you want to help us out there?
Yeah, absolutely. What we saw over that period, Roger, was what we call a bear market rally. We saw particularly gold stocks come into favor. During that period, we saw the pace of interest rate rises just plateau a bit. Inflation moderated slightly. We saw the US dollar actually fall in value, and the gold price rose quite nicely. So it was what we call a bear market rally, but just somewhat short-lived, Roger, but was a positive boost for the market during November.
Absolutely. Thanks, Colin. And you can see there on 15th of October, which was a market low. And Angus did say that S&P 500 looks similar to what happened in July, and the index looks set for an instant replay and rally into November over the coming weeks. And again, what do you know? October 15th was the low. And since then, the index has rallied 17% in a matter of a month and a half. Absolutely huge. So again, he was bang on there. And finally, where we are at today, he's saying this is a picture of the parachute that he just put up a few days ago in his daily note to members. He's saying parachute should be packed, and I'll point the mouse there, you can read it, and at the ready. So he's saying for traders on the long side, get ready to jump. And the technical rebound, which I called back in October, now looks long in the tooth and nearing an end. And the final one I want to show you is what he's saying today. And this is a chart he published in his daily email today. And he's saying the S&P 500 is testing key near-term support of 39.37, where you can see the little circle. It's testing that support line. And he's saying my base case is for a decisive break below this level in the coming weeks. And we have unfinished business with both volatility set to surge and benchmark indices set to come under renewed pressure as we head into the first quarter of next year. So he's called a lot of these swings in the market absolutely accurately. And again, he's now calling for a retest of the previous lows and going back into the downwards pressure. So if you find that that could help you, in fact, maybe what I'll do is I'll put up a question for you now. Let's get your views on how you see the markets in 2023. Let's get a bit of a fun going on. We've got about 400 to 500 people watching this right now. It might be interesting to see your feedback as to how you see the markets next year. It's all about next year now, isn't it? So do you see the markets having another negative year next year, or positive, flat, or you're not sure? Let's get a feel of what you're saying. So I'm going to close that now. There's quite a few people who've posted their responses, and let's close that now. So we've got consensus saying 54% saying it's a negative year forecast for next year. About 23% are saying positive, good for you. There's about 10% saying it's going to be flat, and the rest are not sure. So most people are expecting a negative year next year. Okay, we'll see what happens. Now, over to you, Edward, to talk about Fat Profits. A little bit of an intro, who we are, what we do.
Yeah, very briefly, founded by Angus Geddes back in the year 2000. We initially started with a mining report, specialised in mining, and then in around 2005 we launched Australian Equities Report, and then eventually UK and global. But the differentiation between us and the rest, one, we manage money. So most of our members are with us because we actually have funds under management. We're not a newsletter. We're not free content, so we don't sell your email address to give you free content. It's a paid membership. It's an alternative to a stockbroker or a financial planner. It's education, first and foremost. It gives you the information that you need to help you make informed decisions. And essentially, I've been in this for over 20 years. If you're not using research or guidance in the markets, you're basically guessing or gambling. And apparently you need a card for that soon for gambling. But we do have a global reach. We've got members all over the globe, a lot in the UK and Europe as well. But most of our members are in Australia, and we have a big following in New Zealand as well. We've been, I think we're in our 22nd year, going on 23 years now. I've been here for half of that period, Roger. Yes. But yeah, members generally make money over the medium long term, and they trust us. That's the key. We are a trusted research service, and the main reason is that we put our money where our mouth is, in our managed accounts.
Absolutely. Thanks, Ed. Yeah, you've been with the business for about 12 years now. So out of 22 years, the business has been operating. So that's a good sign. And you've seen all the peaks and troughs. So thank you, Ed, let's move on to another key part of our service in our research team is our mining analyst. So Colin, tell us a little bit about David, please.
Yeah, I'd absolutely be pleased to, Roger. And so Edward mentioned a moment ago that Fat Profits started with the mining report. And so therein lies a little bit of a story about David Lennox. And so via David Lennox, Fat Profits has a rich history in the mining sector, in the resource sector. So the great thing about David, he's very approachable. I talk to David almost every day. I sit not far from him in the office, and he's a great guy. He's very knowledgeable, Roger. He's got deep experience over 40 years. But not only that, he's got great expertise. He's really been one of the standout resource analysts in the Australian share market for the last 30 or 40 years. And really therein lies the strength of Fat Profits with the Global Mining Report, thanks to David Lennox.
Absolutely. Look, the one line which comes to mind is, we do the research so you don't have to. And that's the one reason why we have 25,000 members, so that you don't need to do all the research. We can do a majority of that for you. You can still support that decision making for yourself. Now, one of the sectors that David is very keen on, he's quite bullish on, is gold. So over to you, Edward. Tell us a bit more about the gold sector and some of these stocks.
Yeah, look, it has been a tough year, but it's coming good. I mean, the US dollar has been strong all year, but it's showing signs of weakness, and the cracks are definitely there. But we do have two stocks here that have actually gone up this year, Northern Star and also Gold Road Resources. So they're well on track. They haven't had the COVID-related issues that Evolution Mining has had. And also Red 5 is just recently, they were having a wonderful year, and then they recently had to put a capital raising. So it's all about timing, and the stock is now down for the year, but at one stage it was up around 60% for the year. So these small caps and micro caps, you do need to take profits along the way, because capital raising could very well be around the corner, and then there's been a lot of that. Northern Star, you can clearly see there, one of the leaders in operational highlights. You can clearly see there, their cash earnings are strong. But the thing is with this stock, it's well on track. And one thing it's done against its peers, it hasn't scaled back during COVID, so it's continued to progress. You can clearly see there some of the milestones there, Kalgoorlie, Yandal, and Pogo. And you look at the chart down there, the numbers are going up for this stock. So if gold, it has already broken out to the upside, but if that continues, if it can get anywhere close to $2,000 US an ounce, the profitability is going to go through the roof for this company. So the balance sheet is going to be very strong and healthy. You can clearly see in that chart there, the stock is well underway. If it breaks through that previous April high, I think it was around $14, Roger, it'll go pretty strong. So it's at a critical level at the moment, but it has been a strong stock in our portfolio, one of the better performers this year. Evolution Mining, on the other hand, has had operational issues all year. They have had to scale back on a lot of their exploration, but they've also had exploration success. The portfolio, they divested Mount Carlton to Navarre Minerals. So they've de-risked there. Good for Navarre, but not so good for Evolution, because they've had to focus on their larger projects, right? So their focus is growth. So, Cowral, their underground mine there, Red Lake, that's where their focus is. But again, the numbers are there, 44% in their operational performance. You look at the charts, it bottomed out at $1.80 recently. We have been buying at that lower level. Based on the valuation, there was at least a 50 to 60% gap. That placed it in buying territory. It is on the way up. I noticed a few of our competitors have been buying this stock as well, because it's the undervalued stocks. It's the turnaround stories that can make members or investors money. And that's what we focus on. So if we don't believe there's upside, we'll place the stock on hold. And if we believe there's upside fundamentally and technically, we'll place a buy on the stock. So it's still a buy, almost hit $3 recently. and it's pulled back. If it breaks $3, should hold, and the next stop will be 350. So it's at a critical level at the moment.
Yeah, absolutely. It's up about 60% off its recent lows. So anyone looking at undervalued, and Gold Road being the last one, look, it's actually done quite well, even though gold prices have been a little bit down, but it's been a pretty good year for them, up around 25%. They paid dividends as well. And look, you can clearly see in the last 6 months in particular, they've actually held up pretty well. So that's another stock you can check out. So that's gold for you. Thanks, Ed. Moving on to industrials, I'll quickly highlight, look, we certainly want a few industrials in our portfolio as well. You know, yes, you've got commodities. Yes, you've got gold. We've talked about, you know, the soft commodities, agriculture as well. Well, industrials just about as important. So there's a few examples for you. While the market's been down, there's a few standouts this year. So APA Group, that's the energy provider, big infrastructure company, up about 20% this year. Perenti is the standout I'm going to talk about. I will come back to that in a moment. And Qantas, well, what a phenomenal year it's been for the Flying Kangaroo, turnaround story. And Amcor is quite good defensive stock. So these are few industrials which have still gone up against the market trend this year. So one of the standouts, you may probably never heard of this company, is Perenti Limited. And what they do is they basically infrastructure for mining services, and they basically build mines for different companies around the world, not just in Australia. And they're quite a big company. You can see in the financial results, which were updated recently, the revenue was $2.4 billion, up around 21% compared to last year. Most of the numbers were actually rising. And as I said earlier, the one key thing which drives the share price higher is rising earnings. Rising earnings, rising share price. Falling earnings, falling share price. It's pretty clear. However, what you want to be in these type of companies. If you also look at some recent announcements, they announced a joint agreement with ABB recently, where both companies will work on a strategy for net zero emissions, and they'll be focusing on clean energy and electrification of mining operations, which is of course a very positive step in the right direction. Again, operational numbers were pretty strong right across the revenue, earnings before tax, and the capex as well. So all in all, company's in good shape. And what does the share price tell us? Well, from August onwards, you can see a fantastic turnaround. From 56 cents, this stock has doubled. It's $1.12 right now. So a stock which has doubled in 4 months in a market which has been very choppy, volatile, and been down. So these are the type of stocks where you want to be placing your hard-earned money, and that's one stock. We're not recommending for you to pick it up today because it has had a phenomenal run, but we can give you the timings of when to make an entry and also when to sell. So this is one which has done well. The next stock is Qantas. Now, this stock actually divides a lot of investors' opinions because some people love Qantas. They're true supporters of the Flying Kangaroo, while the others not so much. But nonetheless, as an investor, you must put the emotion aside and look at the logic. Over the last 12 months, this has been suppressed because of low demand due to COVID, but we've seen that as a turnaround story, and they've been doing everything they can to get it up and running. So what we did was in 2020, in September, you can see that there, we got in at $3.79. We saw that as a bit of a turnaround story for the next 2 years, and it's had its ups and downs. We bought it a few times. It has picked up off support around $4.30, 2-3 times, and now we're seeing the real demand pick up. The government even is urging the travel companies like Qantas and Virgin, etc., to do everything they can to meet demand, because the demand is surging again. The share price is following, and it's now back to above $6. So anyone who picked it up at $3.79, $4, $4.50, $5, everyone would have made some money. So this has been a very good story. It is currently a hold, but we've picked a good one there. Colin, next sector to review is telcos, and quite a few people hold Telstra, if not some of the others. So how do you see the telco space?
Yeah, the telco space is a very important space. In some respects, it's a defensive sector. If you look at Telstra, for example, that's a genuine blue chip stock. It is a defensive stock. And by the way, Telstra is Australia's largest telecommunications company by market share. So it's a very strong company, well favoured by fat profits. It's got a fully franked dividend yield of 4.5%, and that's not too shabby, Roger. The last 3 years, Telstra's been on a journey of transformation, and that's set it up to succeed and grow into the accelerating digital world. And that's certainly a stock that we have a buy on, a current buy at around $4. And Telstra increased its dividend for the first time in 7 years, following the successful completion of the T22 program. Telstra is also capitalising on the exodus of customers from the Optus data breach incident, and the stock has traded in a narrow range between $3.60 and $4.30 this year.
Okay. Spark New Zealand, what are your thoughts there? Not a lot of people know about Spark, but that's the biggest telco in New Zealand and listed on the NZ market and also on ASX.
Well, absolutely, Roger. This is really a stock, I should say, to get excited about. Spark New Zealand. As you can see on the chart there, it's all about a smart automated network. And when they say smart automated network, they're referring to 5G. So 5G, the latest technology in telecommunications, has gone live in 21 locations across New Zealand. The optical transport network 2.0 is now 87% complete. That's quite a fast and effective rollout. And their internet capacity has doubled. So this company is really on the move. We first got into the stock at around $2.11. It's on a hold at the moment at $4.56. Quickly coming back to the financials there, very strong financials, setting up this company for future growth. And if you look at revenue, it's up. Also, net earnings are around $400 million. It's very strong. And so this company is an exciting company. It's certainly one worth keeping an eye on. It's got a tremendous future and very strong financials are setting it up for future growth. As I said before, we initially got into the stock at around $2. It's now around about $4.50. We have a current hold on it, but members and investors should really have this on their watch list, and it should present tremendous value as the market bottoms out next year. This is really one to look at, diving in and buying on the dip when it's undervalued.
Great, good explanation there. It's currently around $4.90, so just trying to get to that $5 range. Keeping in mind, these are good dividend payers. So Spark New Zealand also pays a very strong dividend of 5 to 6% a year. And of course, Telstra, we all know, has always been a good dividend payer. And you can clearly see the Telstra channel this year has been a strong one. And while it remains around $4, as Colin said earlier, it is a stock we're going to firmly hold in our portfolio. Next sector, which is, probably one of the strongest ones for retirees, self-funded investors, fund managers, and you name it, is financials. Now, the Australian financial sector is actually very different than the US and some of the other European banks. We're in a very strong position due to good management, financial health, and lots and lots of free cash flow. So our banks are actually well positioned to withstand any volatility in the housing market, which we are seeing at the moment. So we cover not all the banks, but we cover 4 or 5 out of the major banks and regional banks as well. NAB and Westpac have done reasonably well this year. So let's have a quick chat about ANZ first. So I'll cover that. ANZ announced a few months ago, as you may recall, that they're going to buy Suncorp, the Queensland bank, and they're going to buy the banking arm, not the insurance arm of Suncorp. And that was a strong announcement. They've raised capital at about $18 something earlier this year, which was well subscribed. Overall, the dividends are sort of close to that 6% range. The cash profit is very strong, about $6.5 billion. They've also done a share purchase plan earlier and a buyback as well. So the acquisition of Suncorp Bank, we think is going to be fruitful, and that will provide good value back to the shareholders. In terms of share price, look, it has, performed reasonably well. It hasn't been an absolute standout like a NAB, but it has performed reasonably well. And look, if you look at the last 3 months in particular, past their the share purchase plan to buy Suncorp, it's actually risen from $18, $19 and now around 24. So currently, we're happy to hold ANZ, and we think the financial future for this bank is strong. NAB, on the other hand, has been a better performer this year out of the big four banks. Colin, maybe I'll pass it on to you to talk a couple of key highlights.
Yeah, as with ANZ, Roger, as you've rightly pointed out, the NAB is part of a very strong Australian financial sector. The Australian financial sector has been a real standout over the decades. We've got one of the largest retirement and superannuation industries in the world, and one of the best performing financial sectors. And our top four banks in Australia are internationally recognised as some of the best in the world. If we have a look at the chart there, you can see that income is up 7.8%. Underlying profit is also up 11.2%. Now, these are good metrics, Roger. These are very encouraging signs for investors to have a look at this stock. It is a buy, bearing in mind that it's a defensive stock, it's a high income stock. You can see from the chart there that we originally got in around $17 a share. It's risen up very nicely. We've got a current buy around $31 a share. It's kept the trend there. The trend is very strong. But once again, in times of market volatility, Roger, blue chip financial dividend stocks are worth their weight in gold because they help smooth out the volatility in the market with a regular stream of income. And in the case of NAB, the dividend yields have been around 9%, fully franked, and that's certainly a very good performance for the NAB.
Absolutely. And look, as we expect more volatility next year, as we talked about earlier in the webinar, look, these are the kind of defensive stocks paying you good dividends, the likes of Telstra, Spark New Zealand, the banks, etc., that can hold your portfolio together and not, go down as much as the overall market or some of the other growth stocks. And look, finally, Westpac, while it hasn't been as strong a performer, we do feel there is some value in Westpac. So if you're looking for one of the better value out of the big four banks, Westpac represents a pretty reasonable discount compared to its fair value. So that's one to check out as well. Moving on to another part of financials is financial technology companies, which is referred to as fintech. And look, not a lot of people know about these companies, Ed, but we've been researching and buying and selling a lot of these companies over the years. Tell us a brief about it, one or two, maybe Hub24 perhaps?
Yeah, look, this table shows the performance from our initial buy on this stock. So it goes back quite a bit, but Hub24 is one of our best success stories here. I remember back in 2013, I think we initially put coverage at about $1 a share. Yes. And it's just gone up every year. It's one of these stocks, growth stocks, that you can just put in your portfolio and just keep going up and up and up. Reason being, funds under management continue to grow. This is also a potential takeover target for the future. So it's firmly held. The institutions hold this stock, and they hold a lot of it. You can clearly see every time it drops on the chart there, it just bounces straight back up. And a lot of that has to do with its reporting. Its reporting is consistently up, funds under management growing year on year. So yeah, you can clearly see there. We just put a hypothetical example, but some of these are real. I've been doing portfolio reviews, Roger, under our portfolio service that we launched this year, and I've seen a number of these from our members that actually picked up this stock and put 10 or 15 or even 5K into this stock and had those returns. And some of them took profits when we took profits in recent times. Some have actually just held on and kept it going. They just buy and never sell. They're bottom drawer investors, but that's fine. They're in charge of their own money. Sometimes it pays off, sometimes it doesn't, but in this case it did. So this is a consistent performer. It's a growth stock primarily, but it's one that's definitely delivered results for our members. I've seen some portfolios here that made a lot of money out of the stock. So absolutely, it's a good one, but again, you've got to buy it at the right time. So it's all about timing, and currently it's a hold recommendation.
Well, the old saying, Ed, early bird catches the worm. So of course, if you get into early into these companies, like this is a classic example, $1, $2, $3, early in the piece, that's when you're going to get the worm. So, you know, we do a lot of research here at Fat Profits. Look, let's look at property sector. Look, this is a sector which has been under pressure, of course, for obvious reasons. Interest rates rising, property sector under pressure. So a lot of the stocks have come off a little bit in the last few months. Having said that, you know, there's a few that have held up pretty well. So look, we don't get everything right at Fat Profits. We're not here to say, look, all our stocks just go up. Look, that's not the case. And we're very open with our members. So some of them have gone down, like Boral is down. But, you know, also this year has been a bit tricky for property markets. So a lot of our stocks, we moved back to a hold recommendation. Very few are buys. But if you look at one of them, which is probably one of the better companies, is Vicinity Centres, VCX. So they have shopping malls around Australia, about 60 of them. They're a top 50 ASX company. Value market cap is around $8 to $9 billion. They pay a healthy dividend of 5 to 6% a year. They own the Chadstone Shopping Centre, as an example, in Melbourne, which is very famous for its lavish shops. But all in all, post-COVID, when the stock dropped from $2.75 down to $1, it has made a reasonable recovery, just continues this slow and steady uptrend, and now just shy of $2. It hasn't seen a huge fall because slightly different than your residential housing market or property market. So we think these are the kind of companies with top 50, top 100, paying good dividends, hold up well in volatile markets, and this is another example. So maybe for next year, as you start to look at your portfolio, maybe start to trim a few things down, these are the kind of stocks you might want to consider to add or remove from your portfolio. Now, Colin, not only we tell our investors what to buy, what price to buy, but we also tell them when to sell. Now, in the last 12 months, this table shows some of our sell recommendations to free up some cash, lock in some profits, and just allow investors to manage the portfolio better. How do you see our sell recommendations over the last year?
Well, just quickly, the sell recommendations have been spectacularly successful, but I want to just quickly touch on something you mentioned a moment ago about we're very open and transparent here at Fat Profits about the ones we don't get right. And because we're so open and transparent, that's actually makes us a trusted source of reliable information. And you can see overwhelmingly from the chart, there's only two that we didn't get right in this particular chart. We generally get it right around about 70 to 80% of the time. You can see that we've had some spectacular results there from the fintech sector, with Mainstream up an annualized return, I should say, 85%. And we've also had Whitehaven Coal. If you look at the annualized return, 149%. But you know, with Nine Spokes and Saver Limited, we didn't do well. But we're very open, we're very transparent. And once again, Roger, that does make us a trusted source of reliable information. And our members have made a lot of money over the years from our successful sell recommendations. Absolutely. And there they are on the screen. And I've highlighted a couple of standouts for you.
Yeah, absolutely. Look, Hub 24 is the big standout at 10K. But look, all in all, our view is if you're with our service and you know you don't just buy one stock, hope for the best. You know, we encourage our investors to buy, you know, between 5 and 10 stocks in a year if you can, and gives you a fair chance to make some good money. Well and truly more than what we, you know, ask for the membership fee, a very small fee, but it helps you with your education and investing. Now, here's some good news. If you want to learn, which I guess is part of the reason you're watching this webinar right now, you want to learn and you're open-minded to some ideas, well, here's something we've recently done. We actually did a education workshop, which was for 2 hours, and we had our members watching it live. They paid for it. It was a paid workshop because they wanted to invest in their own education and become better traders, better investors. So this was all about technical analysis, all about charts, entry points, exit points. So Gary Burton, our chief technical analyst and our equity analyst, he's the one who hosted that, and it was phenomenal success. So what we're giving away today in the spirit of Christmas is, and you stay tuned, we've got something good coming up in a moment, some good news for you because Christmas is just around the corner. we're offering a free recording of this workshop to some investors who are willing to look at our service and join us. Now, this, all you got to do is just hit the play button. We'll email that to you, and you can go to certain sections of this education workshop, which I hosted that along with Gary, and I can tell you that it actually opened my own eyes to some new ideas, which I had no clue about, and I've been in the market for a very long time. And here's a couple of examples for you to look at. As an example, we showed how to look and draw your support and resistance lines, and when to look for breakouts. And when they happen, they're phenomenal, and they provide a boost to your returns. We looked at Bollinger Bands. You may have seen that before, how to look for key entry and exit points when they start to expand or contract, and when is a good time to enter or exit using a Bollinger Band strategy. Another example we looked at is moving average crossovers. So you look at two simple moving averages, draw them in your chart, and look for the crossovers. You can see that there, when a certain crossover gives you an entry point, and the same on the other hand gives you an exit point. And if you can use that successfully, it can allow you to lock in profits and sell at the right time. And here's another one, which is Gary's favorite, is Relative Strength Index, RSI. And this really shows you the divergence when the RSI at the bottom starts to go down, but the stock's making higher highs. That is a bearish divergence, which follows the price lower. We also talked about defining support and resistance, how to add them to your charts correctly. There is certain ways to add them in the right manner, and this is an example of how to draw them and use them correctly to trade your markets. So we've got a free copy of that recording available, but we're going to talk about that in a moment for certain investors who want to join hands with Fat Profits, and we're going to make that available to you. But just before we get to that exciting part, Ed, over to you to talk about some of the reviews from our existing members.
Yeah, just like every other product or service in the market, Roger, everyone's providing reviews, whether it's a Google review or review.com, which is, I believe this one's the largest one in Australia. So I generally review every service that I attend, whether it's a restaurant or anything, on Google Maps. Type in the address. After that, they ask you for a review, and I generally provide reviews and feedback, because that's how companies improve their product and service. If they're not constantly receiving reviews, good and bad, they can't make changes accordingly. So these are just some reviews off that website. I think it's called productreview.com, and these are our members that have given, this is their reviews, how they've benefited or not benefited. Most of them are good, as you can see. they've all really appreciated the advice, because at the end of the day, all our members are managing their own portfolios. So it's their hard-earned money. It's their risk that they're taking. They're obviously not going with stockbrokers or financial advisors. So they really appreciate the advice. And when you're making thousands and hundreds of thousands of dollars in profit, when you're paying potentially hundreds of dollars for your membership, they really appreciate that. So they tell us in black and white. This guy here, he's a popular one. He's an ex-stockbroker, retired fund manager or stockbroker or both. And to get this one was quite, we were all shocked in the office. And he's been stockbroker for so many years, his whole life, and he's just realised how independent and subscription-based research advice can help do it yourself or self-guided investors and make their own decisions. And he really appreciated it and voiced that out. Penny's been a long-term member. She's actually one of my members that I've looked after for a very long time. Always appreciates the advice, always sending emails in, asking questions throughout the year. And to have that answered, without paying any brokerage. I mean, normally to get that support, you'd have to go through a full service stockbroker to ask these type of questions. But our account management service is what they appreciate. And the members that use it do very well. The ones that don't, unfortunately, they're paid for something that they're simply not using, like every other product and service. So if you use it, you'll benefit, like anything, like massage chairs and massage machines and exercise equipment. If you don't use it, you won't benefit. Gym memberships, obviously. So if you use it, you'll benefit. There's some black and white reviews there. So these are real reviews, real people that really appreciated our service so much that they went out of their way to put up a review for us. And we greatly appreciate that, Roger.
Great. Yep. Thanks, Ed. You're right. You hit the nail on the head. Look, you got to use it. So if if you're considering using Fat Profit service going forward, and it's a very small fee. Look, honestly, you'll be doing yourself a favor before Christmas if you were to consider our service, because if you use it, you're going to benefit absolutely. We've got it right more often than not this year. You've seen some examples already. So, Colin, tell us a few things that people like about Fat Profits.
Well, I think the overwhelmingly the number one feature of Fat Profits that attracts investors to our service is our performance. It really is unsurpassed, Roger, in the share market research industry. We've been at it for 22 years. During that time, we've really established ourselves as the leading share market research house in the Australian share market. So we can obviously provide our members and investors with regular updates on the market outlook. We also get it right between 7 and 10 times. Saving time on research is very helpful for investors. It can be at times quite complex. We take the complexity out, we make it easier for investors. We're very experienced. I mentioned before the experience that we've got in the firm with David Lennox, 30 to 40 years experience in the resource sector. Angus Geddes has been in the share market business since the mid-1980s. So we get it right 7 out of 10. We provide guidance, we provide a view, we give a market direction, we give a macro view, we obviously give individual share market recommendations. We won't bombard you, however, with cross-selling and upselling. We do have dedicated account managers who are available for service calls by agreement and at your discretion. An account manager is available 9 to 5, Monday to Friday, to take your calls. And as Ed mentioned before, we do manage real money. Now, this is important. The classic phrase, of course, is we've got skin in the game. We have got skin in the game. It's well over $150 million. That gives us an extra level of credibility, knowledge, and expertise, Roger.
Yeah, absolutely, Colin. So well said. Look, let's give away the good news, because it is in the spirit of Christmas. We've got some good news here. So just before we explain some really good prices that we've put together for those of you who want to continue with our service or join us, we've got 2 memberships we're going to talk about today. 2 of the most popular memberships we have is Premium and Platinum. It's very simple. Premium memberships gives you access to the daily Fat Chat market commentary. That's a daily email from Angus. Comes in your inbox every morning. We talked about that earlier. As you know, he gives you the absolute points on when he's buying or when he's selling. So this is very important, and people have made money from just the daily emails. Second benefit is the weekly members only webinar. Now, as you've seen in this webinar alone, we provide a lot of research. We look at a lot of indicators, what's moving the market, what's happening at the back end, which you as a mum and dad investor, look, unfortunately, just simply want to have access to, and probably don't have the time to either. So, we do the research so you don't have to pay a very small fee. That webinar that we do every Thursday, it's live. It's at 12 p.m. Sydney time. It's for an hour. And it's also recorded. If you can't watch it live, we email you the recording. And that really helps you understand what's taking place each week in the market and just keeps you educated and informed. The third key benefit is the Friday Fat Wrap, which is a wrap up of any highlights that you may have seen or missed out in the week. So those 3 benefits are across both the membership types, whereas the key difference between Premium and Platinum is with Premium, you have access to 2 of our 4 reports. So we publish Australian equities, mining, and global equities. In fact, global and UK are now 1 report, so apologies there. They're actually just 1 report, and global equities. So any of the 3, you can pick 2, and that is the Premium membership. Plus you get the account manager, but like you've heard from Edward, who's our senior account manager, been with us for 12 years, so you can draw on his experience to talk about the markets. There's no additional cost for that. It's just included in our membership. And Platinum or it gives you access to all of our reports. So if you're an international investor, we suggest you go with Platinum, because you have not only Australian equities and mining, but you also have global research on US, UK, Europe, Asian markets, plus the account manager. And you have someone like Colin as well, who you can draw his experience, been with the financial industry for 20 years. So you can talk to Colin, Edward, and many other account managers during the course of the year if you're with them. So over to you, Edward. Tell us the good news.
Yeah, look, this is our lowest offer for the year. So usually we offer standard, premium, and platinum, Roger, but we really want to help members. So we want to give members an account manager. So every member that joins from this webinar, and also during the month of December, we'll get the account management service. So most new investors try us out for a year and they pay the retail cost on the website, and some go for standard, which is what, $1,095. You don't get to speak to anyone, and that only includes one report, which is Australian equities. So today you can have the full premium membership, which normally retails at what, $1,595 a year. That's our standard 1 year renewal for just $995 a year. So it's basically 40% off. You get pretty much everything except global. And you get the popular weekly webinar, which is actually recorded as well for people that work full time. And we actually send you a recording on the email there, and that goes through all our latest advice for the week. So in 1 hour, you get a full update for your portfolio. But Tuesday night, you get your equities report. Wednesday night, you get your mining report. I know it's called global mining, but it's actually mainly Australian stocks. It's about 20% global. If you want better value, most of our renewals are generally 2 to 5 years. But for new members, most join for at least 1 or 2 years. And the better value, we'll actually give you 2 years for the price of one at $1,545 for 2 years. The website price is actually $2,795 for our 2-year renewal. So we've dropped that down. It is Christmas, so $1,545. And this webinar is about new members in particular, or current members that want to improve their performance. So here's your chance, right? If you're not using research to make decisions within your portfolio, you're basically gambling. Good luck with that. So basically that's $770 a year for 2 years, okay? And then platinum, which also includes our global equities portfolio, which covers global markets. It's generally for people got larger funds, self-managed super funds, which should have some global diversification in there as per requirements. Normally $25.90 a year on our website. Basically half that cost, $12.50 a year for 1 year if you'd like to try it out. If you're going to be in the market, obviously for many years, we'd recommend getting the better value, which is 2 years. Now, this is $1,000 cheaper than what we've offered throughout this year. So it's $1,995. It's only $1,000 a year. One good idea a year should be able to cover that. Everything else is a bonus. And for members that are interested in or new members that are interested in a portfolio review, click one of these boxes on the poll, and we can discuss that over the phone. But we do have a portfolio service available for members that would like a second opinion on their current portfolio and like to get a fresh start going forward with our service. We do have that service available as well, Roger. So here you go in the poll. You can click. We've got a few clickers already, Roger. We've got a few people going for premium already, and a few people want to discuss it further, and a couple of platinum as well. But it's all about a fresh start. That's what these webinars are about. It's to explain our service, to show you how you can benefit, and we're only here to help. So we're in an industry of education at the end of the day, and if you've entrusted yourself to manage your own portfolio, full-time or part-time, do yourself a favor, get yourself some good research, especially if you have not been performing in this market, because you've clearly seen our results. We've shown you in black and white and green, and green means that members that bought those stocks have actually made money this year. Yes. Roger?
Yes, absolutely. Thanks, Ed. So look, Anita just popped a question. She's saying, I love the presentation from earlier about the markets and also the market direction that Angus is pointing out. I'm quite keen on the recording. So I guess the question that Anita's asking is about the recording of that workshop. Now, just so you know, Anita, what we're basically doing is either one, if you join in our service today, you can take any package, they're all discounted. So you can take the premium 1 year or 2 years, platinum 1 year or 2 years. In either of the packages, we're going to give away absolutely free of charge the recording of that technical analysis workshop. That is a value of $400, absolutely yours for free, and you can have that forever. We will email you the recording and you can play that over and over again to get yourself really right as an investor and as a trader. So that's yours, Anita. You can have it today and you can get yourself on the way to a better 2023. If 2022 hasn't been a great year for you and you come into this webinar today with an open mind and you really want to learn something and you want to get better next year, well, we encourage you to join us. Try us for 1 year, 2 years, doesn't matter. It's something you're going to find as good value. So that's one for you. Next one is from John. So we've got a question on the portfolio. He said, Edward mentioned earlier about the portfolio review. I have about 35 stocks in my portfolio. I'm sitting on 20% cash, but I'd like to raise a little bit more in anticipation of what you said earlier in the webinar. There is a more downside risk coming next year. So how can I talk to you guys for the portfolio review of my 35 stock portfolio?
Yeah, Roger, look, we're happy to help. Obviously, if you want a portfolio review before Christmas, you're going to have to be pretty quick. We've spent the last, I think, 6 months with our new portfolio service. We've been doing reviews pretty much on a daily basis for members that want that access. So look, just join on one of these services. We'll discuss it over the phone. We're happy to help. Most of our members took up an option of an annual portfolio review with some of our longer term memberships, but we're happy to help. Just click one of the options and myself and Roger, we generally do the reviews for compliance reasons. We'll be happy to help you. It's not a problem. Or you can just click I'd like to discuss further. We can have a chat, but we're here to help. I'm pretty sure at the moment we might be able to get a number of portfolios done before Christmas, but our focus at the moment is welcoming new members on board, and then we can organise, if you want that portfolio service, we can actually add that as an entitlement on your membership.
Yep, sure, thanks Ed. And look, the last one I'll just take quickly because we've got a lot of responses so far, so thank you for everyone who's showing interest. And look, this is a very low price offer, and I think a lot of you find good value for Fat Profits. Last one is Jennifer. She's saying that I am an ex-member of Fat Profits, dropped off about a couple of years ago due to some reasons, but now I'm looking to get back in the market. Just sold a property as well recently. I'm sitting on a reasonable amount of cash. Thank you for the presentation. I've learned a few ideas from today's webinar, which I didn't know was existing in the membership. So I'm looking forward to joining you with this new service. Thank you, Jenny. We look forward to working with you. So look, on that note, we will close the inquiry forms, and we've got enough people showing interest. Thank you very much. And that brings us to the end of today's webinar. If you found the webinar informative and educational and useful, please send us your comments or feedback via email to info@fatprofits.com.au. If you do have any questions as well, and you want to email us, that's the email, or you can call as well. But look, on that note, I'm going to pass it back on to Colin and Ed for their final words. My name is Roger. Thank you for your company today. We hope that from today's session, you've picked up some ideas on the kind of stocks that we cover. We've given it quite a lot of sneak peek into the kind of sectors that we're happy about or concerned about, and also the market direction, which is really the main thing, is what is in store for next year. So hopefully you can position yourself accordingly, and we wish you all the very best in the markets. And I'll pass it on to Colin first for his final words.
Well, thank you, Roger. Look, it's been an absolute pleasure to present with you and Edward today. So I'd like to thank yourself and Edward for today's presentation. It's always enjoyable, Roger, to present such a strong performance of our company, Fat Profits, in a very difficult market in 2022. So look forward to presenting in future. Just like to wish everyone a wonderful Christmas season to themselves and their families, and a prosperous 2023.
Thank you, Colin. And Edward.
Yeah, look, just looking forward to welcoming new members on board, and I'll just take this opportunity to wish everyone a Merry Christmas, Christmas is all about family and giving, a time of giving. So, you know, we're here to help our members. Our service is a membership-based service. It's not a brokerage service. So everything we do is for our members. It's basically a family-based operation, small business, Australian owned and operated. So we're here for our members. That's what you'll be joining today. You'll be part of something to help you grow your portfolio, whether it's a personal portfolio or a self-managed super fund. We're here to help. We're here to give you good advice, sound advice, and how you use it is entirely up to you. It's your money. So good luck with that, and hopefully we can help. Have a great day.
All right, thank you.